William Lee, and this is my Finance 451 Bloomberg analysis project. So the goals of this project were to analyze 10 firms total across 2 different industries. It would be 5 in each. And then my job was to pick the highest performing firm in each industry and then put those 2 firms together and see which one was the best overall. So for the 2 industries, we had a class industry that was the oil and gas industry. We had Exxon, Chevron, ConocoPhillips, Hess, and Marathon. And then I picked the textiles, apparel, and luxury goods, which was Skechers, Nike, VF Corporation, Under Armour, and Columbia. I picked that because everybody sees these companies every day, and I thought it would be cool to see how they were doing financially as stocks. Alright, so first we're going to look at the oil and gas industry. What I wanted to do first was kind of take a look and see what companies were, their market share, how much of the market each company was in. So you can see up at the top you have Exxon, XOM. Their market cap was significantly higher. They finished in 2015 with 323,960.2 million in US dollars. The next closest was Chevron with 207,994.4, and all the way down at the bottom, Marathon is pretty small compared to the top 2 with 13,758.7. Also have their enterprise value on there, which Exxon's, it's kind of related to the market cap. Exxon's also much higher than all the other ones. So then, next thing I want to do was look at each firm's liquidity. I chose the current ratio, just kind of get a quick snapshot of it. You can see Chevron in 2011 started out, they were handling their debt, their short-term debts really well. They were their ability to pay their debts, they were the highest. You see Marathon starting out there at the lowest in 2011, but they really did well of kind of rebounding up in 2015, getting up to the 1.5 mark. Chevron kind of dipped down to 3rd, and Hess made it all the way up to the top. And then you kind of have Exxon in there going up and down all the way to the bottom. Same thing with ConocoPhillips, kind of fluctuating a little bit. But in the oil and gas industry these days, it's really kind of hard to stay liquid with oil prices, so it is understandable. Then I want to take a look at a few debt ratios. This we're looking at total debt to total assets. We're looking at how much of their assets are being funded by shareholders, creditors, and you can see, as I expected, Exxon and Chevron, they're smaller companies. Bigger companies. And the bigger companies, they don't need to take on as much leverage, don't need to take on as much debt. So they're down there at the bottom, and you have smaller firms such as you have Hess up there in the yellow. They're kind of getting up there to the 20s, while the bottom 2 are between 10 and 15. So that's kind of what I expected. You have Marathon that's fluctuating a lot. They kind of don't know how much leverage they want to take on. And as you'll see in the next 2, Conoco, they're dead set on just they want to have more leverage. They want more gains. They want to take on more debt. They feel like they can cover their debt so they can get gains out of it. Just like in the last slide, Exxon and Chevron are down there at the bottom again. This is debt to equity, so this is how much of shareholders' equity is being used to fund for their debt and to fund them. And you see ConocoPhillips up there again, rising up all the way up into the 60s. And then in the middle, you have Hess and Marathon again, two of the smaller companies. So then we're going to look at times interest earned, and this is looking a lot different than those prior two. You have Exxon up there, and times interest earned is talking about how well the firm can honor their debts. How well do they pay them back, pay their debts back to their creditors. And as you expect, Exxon from 2011 2014 were just exceptional at that. But as the market kept getting worse for oil and gas, you can see them dip down. And you can see the other three companies down there at the bottom too, as they struggle, even going into the negative in 2015. So we're going to move on to how well these firms manage their turnover, their inventory, their assets. And you can see Exxon and Chevron, two of the biggest firms back up at the top. They're good at turning over their inventory. They're pretty consistent. But as you'd expect in this market, they're also declining. ConocoPhillips shoots up in 2013 all the way to first, up in between 37, and but then they start declining like everybody else. But you see Hess starting to increase again up into 2015. Alright, so then I want to look at these firms' profitability. How are they generating profit in these hard times for oil and gas? What are they doing? We looked at an Exxon, as you would think of one of the stronger, bigger firms. They're doing a good job of staying stable, staying afloat. Their profit margin, yes, it's declining all across the board. But as you can see all the way on the right, in 2015, Exxon has a positive profit margin, positive ROE, positive ROA. Chevron does too, another large corporation. They're also positive in the profit margin, those three categories, profit margin, ROE, ROA. Then you get down to the smaller three. You got Conoco, Hess, and Marathon. Negative profit margins, negative ROEs, negative ROAs. They're not generating profit anymore. Hess just in 2014 had a 21.58% profit margin. So you're just seeing how the effect that this economy is starting to take on these smaller firms and how the bigger firms are staying afloat. So then I saw the positive ROE with Exxon and Chevron, and then the ones at the bottom. I want to see what's driving it. So I looked at the DuPont analysis, and all these oil and gas firms are relying heavily on interest burden and high leverage, as we saw with ConocoPhillips, which is really not what you want. You want your firm's ROE to be driven by an operating margin, how well they're managing their assets, their total asset turnover, not so much interest, tax rate stuff like that. That's what they can't control. So it's not looking good there either. One of the last things I'm starting to look at here was another kind of profitability measure, earnings per share. How much are they generating per share that stockholders have. And just like the rest of the slides, it's on the decline here. We have Chevron and Exxon up at the top again, and then down at the bottom, just as before, you have Conoco, Hess, and Marathon. Just again, kind of what I expected. You see Hess almost dipping it. They're all into the negatives again. Those bottom three are all in the negatives, and it's really not looking good for them. So then I went and took a look at the weighted average cost of capital. It's all looking relatively similar here, but as you can see again, ExxonMobil and Chevron, and even Conoco here, they're generating most of their money from equity. It's not coming from. No, they're generating it from debt. I'm sorry, not so much from equity. Marathon has a high cost of capital right there, and you're going to see the effect that it has coming up in the economic value added. So here we have EVA and the EVA spread in parentheses right next to it. You can see how the market has affected these companies. You have negatives all across the board. Marathon with the smallest, but this is kind of also relative, I guess, to the size of these firms. You have Chevron and Exxon, the two biggest firms, and they're negative, much more negative. But their EVA spreads are smaller than Hess and Conoco and Marathon. That spread is the difference between the weighted average cost of capital and the return on invested capital. So I think this is kind of take it with a grain of salt how high Chevron is. It's just a bad time in the market for these oil and gas companies. I really thought the spread was more interesting than the actual EVA. So then it came down to my decision between Chevron and Exxon, because as you could see in all the slides, they were doing their best to stay afloat in this tough economy on oil and gas with the prices the way they are. Those smaller companies, they're just having so much trouble keeping up. At the end of the day, I chose Exxon over Chevron because Chevron, if you can go back here, let's see. they're getting real close to getting negative on their ROE and profit margin. Exxon is doing a great job of just, they're staying profitable. Definitely still on the decline, so you don't know what's going to happen if the economy stays the same way. So it'd definitely be, they're my recommendation for an investment, but I don't know if I would be investing in oil and gas right now with the just uncertainty of the market. Next, I took a look at the textiles, apparel, and luxury goods industry. Like I talked about before, with Nike and Skechers, VF Corporation, Under Armour, and Columbia. So we had Skechers. They're a smaller one. Of course, you have Nike. They had the biggest market capitalization. Pretty much everybody's trailing. Columbia is really small. Just 3,110 compared to Nike's 66,911.7. And again, this is in millions of US dollars. So moving on, we had same thing. Have the current ratio here, measuring their liquidity. How good are they at paying back their short-term debts? You have Columbia, kind of surprisingly, all the way up there at the top as a smaller firm, but they're starting to decline. While you have Under Armour kind of going up and down. Mostly kind of just fluctuating from year to year with these companies on liquidity. You can't really, at the end, you can see they're all really close together. So there's really no differentiator here with the current ratio. When I really started seeing a difference was with the once we started getting to the debt ratios. You're going to see VF Corporation. They're all about putting on some more leverage. They want same thing like I said before. They want to magnify their gains. While on the other side of the spectrum, all the way down at the bottom, we have Columbia. Columbia virtually takes on no debt. There's only a few instances whenever I was looking through the data that Columbia actually had a positive number for their total debt to total asset ratio. And then you have Skechers on the decline. Nike starting to take less debt coming from 2013 to 2015. And then you have Under Armour taking on more debt too. And Under Armour's been trying to buy a lot more. They're signing a lot more athletes to shoe contracts. So kind of makes sense that they want to take on some more leverage so they can get a bigger market share. Looking at the debt to equity ratio, same thing, VF Corporation. They went on a steep decline, but they were so high in 2011. They're still high up there, top two. Under Armour, like I said before, they really want to get in on the markets. They're going to be taking on some more leverage. Columbia, still really not trying to get into any of the debt game. And then Nike and Skechers kind of the same thing before, declining a little bit. Times interest earned, how well they're paying back their debts. You have Columbia, because they just don't have much debt at all, they're really good. You can see that sharp incline. Nike, as you would expect with a big firm, they're high up there with paying back their debts. And then you have Skechers, VF Corporation, and Under Armour. They're kind of hanging down there at the bottom. This is troubling for VF Corporation because you saw how high they were with their other debt ratios, but it doesn't seem like they're paying it back as well as firms like Nike. So that's kind of a concern. Inventory turnover. How well are they turning over their assets? How well are they turning over their inventory? It's kind of what I expected with the apparel industry. Everybody's selling, but you do have the two with the biggest market share up there at the top. You have Nike and VF Corporation. Under Armour, kind of surprising they were down there at the bottom with how big they've been getting recently, but you're going to be looking to see if they increase later on in those coming years. Profit margin, looking at some profitability now. Skechers was really surprising here. You can just see how from 2011, negative profit margin while everybody else was making money up there at the top. And then you have Skechers down all the way down there, and you just see them shoot up to they're number 3 up there in profit margin, right above Columbia. I expected Columbia to be kind of at the bottom, same thing with Under Armour, kind of smaller. And then you have Nike and VF Corporation. VF Corporation's in a lot of things these days, so they're both up there at the top, as I would expect. ROA, same thing. Skechers doing a great job, their management, at getting them back afloat. They're back there at the top again, even around VF Corporation. can see Nike separating themselves right there, which is kind of as expected, even though they're going through a lot of competition with these firms like Under Armour and like Adidas in their industry. But VF Corporation and Under Armour, they're kind of in the middle of the pack. But like I said, Skechers was really surprising with their growth right here. It's a good sign. And you're going to see the same thing again with the ROE. Nike up there at the top in 2015 again, really separating themselves. VF Corporation kind of hanging with them up there in the around 20, 25 in between there. Nike's coming up on the 30%. Skechers going from negative 7% all the way up to about to be touching 20% ROE. It's really good. Earnings per share. We have VF Corporation earning a lot per share. That's a good sign for them. Skechers again went from negative to positive again. Under Armour, it's not a really good sign that they're so low, finishing all the way at the bottom right there. Not a good sign for them, but as I expected, Nike's still up there at the top too. Looking at their weighted average cost of capital too, kind of the same thing all around. They kind of are balanced the same. VF Corporation doing a good job keeping their cost of capital low too. Probably because of all the debt they've been taking on, like we saw earlier. Economic value added, a totally different story than oil and gas. You have some large positive numbers up there. You do have some negatives. Under Armour and Columbia, not a good sign because it's really not a bad market these days for the apparel industry. And you have these companies in the negative of their EVA, not a good sign. Like I said, the EVA spread is interesting. You see Nike, they're just way above everybody else with that 17.53%. It's a really good sign for them. So, as you can probably tell, I picked Nike. They're just, they're a giant of the industry. They have high profitability, low leverage. They're able to pay off their debts. Just a really good management there at Nike. And then overall investment, I picked Nike over ExxonMobil because it's so volatile with the oil and gas industry. So you don't really know what's happening. And Nike's got higher profitability and a more stable industry. Exxon is above them in in ROE they were better than them, but just not enough to make a safe investment into Exxon, an oil and gas company, over an apparel company. Thank you for watching.